This video is for educational and informational purposes only and should not be considered financial advice. Any analysis of Eli Lilly is based on publicly available information and my own assumptions. Hi, I'm John and welcome back to Nordic Value Investor. In today's video, we are doing a value investing analysis of Eli Lilly. The numbers I'm using in this video are in millions, unless when it's on a per share basis, such as earnings per share, book value, etc. We'll start off by looking at Eli Lilly's historical performance in revenue, earnings per share, dividend, book value, operating cash flow, and free cash flow. We want to see a steady historical growth in these numbers, ideally an annual growth rate of about 10% or higher from 2016 until today. Starting with revenue, converting these numbers into a line chart, we can see that revenue has been growing over the last 9 years. It has shown a moderate growth initially, followed by a clear acceleration in recent years. Over this period, revenue has grown at an average annual rate of 14%. This growth has accelerated significantly in recent years, increasing to 22% over the last 5 years, 32% over the last 3 years, and 45% over the last year. So while growth was relatively flat in the first couple of years, we clearly see that Eli Lilly has been able to accelerate its revenue growth in recent years, driven primarily by the highly profitable and rapidly expanding weight loss market. This is exactly the kind of upward revenue trajectory we want to see. Turning to earnings per share, we see an upward trend over the last 9 years, with EPS growing at an average annual rate of 29%. However, this growth has not been smooth or consistent year by year. From 2017 to 2019, EPS grew rapidly, followed by a decline from 19 to 23, before accelerating again from 23 to 25. If you are familiar with Phil Town and his Rule 1 investing principles, you will know that stable and predictable EPS growth is generally preferred. However, value investors like Buffett and Munger would first try to understand the reasons behind this volatility rather than dismissing it outright. The key question is, what are the underlying drivers? Looking at the income statement from 2019 to 2023, we see that revenue increased by 11% annually, while operating profit grew by 15%. This indicates operating leverage, as the operating margin improved from 26.9% to 30.3% from 2019 to 2023. This is important. The underlying business was getting stronger, not weaker. Since EPS declined while operating profit rose, the explanation must be found below operating profit in the income statement. For simplicity, I have combined all items between operating profit and pre-tax income into a single line item, non-operating income expense. During this period, Eli Lilly recorded large non-operating charges, which grew by 51% annually, and a significantly higher tax burden, which grew by 20% annually. These items grew more than operating profit and directly reduced net income and therefore EPS. At the same time, Eli Lilly was in a heavy investment phase, expanding manufacturing capacity and preparing for large-scale GLP-1 production. This created transition costs and accounting noise, which made reported earnings appear weaker than the underlying business performance. EPS declined not because the business weakened, but because non-operating charges and higher taxes masked the underlying improvement during a heavy investment phase. From 2023 to 2025, we see a sharp acceleration in earnings. Revenue grows by 38% annually, operating profit increases by 70% annually, pre-tax income nearly doubles year to year, and EPS grows by 99% annually. Two things happen simultaneously. One, the business scales aggressively, operating leverage kicks in, and two, non-operating noise becomes relatively less significant. Let's first look at operating leverage. Revenue grows strongly at 38% annually, but operating profit grows at 70% annually. That divergence is direct evidence of high operating leverage. incremental revenue is translating into disproportionately higher operating profit. This dynamic is clearly reflected in the operating margin. After hovering around 30% for several years, the operating margin jumps sharply in 2024 and 2025. This means Eli Lilly is generating significantly more operating profit for each dollar of revenue, a textbook sign of operating leverage being realized. At the same time, non-operating items, which had been a major drag on EPS in prior years, grows by only 3% annually. As operating profit expands rapidly, these items account for a much smaller share of total earnings, further amplifying EPS growth. Tax grows by 97% annually, which simply mirrors the strong growth in pre-tax income of about 98%. So this doesn't distort the overall picture, it simply reflects stronger underlying earnings. This is classic value case behavior. Earnings are suppressed during the investment phase, but once scale is reached, profits surge as revenue grows faster than costs. The sharp EPS growth signals that prior investments are beginning to pay off, operating leverage is being realized, non-operating noise is being diluted by scale. The underlying earnings power had been building for years, but from 23 to 25 it becomes much more visible in reported EPS. During this period, EPS is effectively catching up to several years of accumulated earnings power. Moving on to dividend, here we are just gonna note that growth in dividend has gone from 13% annually over the last 9 years up to 15% annually the last couple of years. Eli Lilly's book value per share fell sharply from around $13 in 2016 to just about $3 in 2019, before rebounding strongly and reaching about $30 by 2025. The collapse in book value from 2015 to 2019 was primarily the result of aggressive share buybacks, which directly reduced shareholders' equity. Eli Lilly spent roughly $10 billion on buybacks during this period. From 2019 onward, book value recovered as retained earnings surged. Explosive profit growth, driven by operating leverage and blockbuster drugs, rebuilt equity despite continued shareholder returns. For pharmaceutical companies like Eli Lilly, book value is a weak indicator of intrinsic value. Most economic value comes from intangible assets such as patents, drug pipelines, and R&D know-how. But the costs behind these assets are mostly recognized immediately as expenses rather than being recorded on the balance sheet. As a result, book value can fluctuate wildly without reflecting the underlying earnings power of the company. Eli Lilly's operating cash flow shows a clear long-term upward trend despite short-term volatility. The fluctuations are normal for a scaling pharmaceutical business and reflect timing and investment effects rather than a weakening core business. The strong rebound in 24 and 25 confirms that underlying cash earning power is accelerating. Short-term operating cash flow volatility is normal in pharma. What matters is that operating cash flow grows faster than revenue over time and that temporary declines are followed by strong rebounds, both of which we clearly see here. Operating cash flow growing faster than revenue is a clear sign of operating leverage, as incremental revenue produces disproportionately more cash. From 2016 to 2022, free cash flow shows a clear upward trend. In 23, however, we see a sharp drop, followed by a rebound in 24 and 25. As shown in the table, this decline closely mirrors two developments. First, operating cash flow temporarily dips in 23, reflecting timing and investment effects rather than a weakening core business. Second, and more importantly, capital expenditures increase sharply over the same period. From 2022 to 2024, operating cash flow grows by 8% annually, while capital expenditure surges by 65% annually. This widening gap explains why free cash flow comes under pressure. While operating cash flow continues to trend upward over time, capital spending has accelerated much faster, driven by heavy investments in manufacturing capacity, supply chain expansion, and future growth initiatives. This mechanically compresses free cash flow in the short term. This is why free cash flow should always be analyzed in relation to operating cash flow and capital expenditure. Free cash flow often looks weak during periods of aggressive investment, and in that context, a low or depressed free cash flow is not only expected, it can be a sign that the company is building future earnings power. From 2024 to 2025, we see a sharp acceleration in operating cash flow, growing by 91%. Capital expenditures continue to increase at a high rate of 55%. But importantly, this is now significantly lower than the growth in operating cash flow. As a result, free cash flow increases by 139%. However, this sharp growth is partly driven by the recovery from a temporarily depressed level. More importantly, it reflects that operating cash flow is now outpacing capital expenditures. This shift indicates that the business is scaling. The heavy investments made in prior years are beginning to translate into stronger cash generation, and the pressure on free cash flow is starting to ease, signaling that these investments are now beginning to pay off. Moving on to return on equity. In part 2, we'll take a closer look at Eli Lilly's financial strength and the overall quality of the business by analyzing key financial ratios.